Perpetual trading in cryptocurrency is undergoing a major shift. In 2016, BitMEXC introduced the perpetual contract model, which became a cornerstone of crypto trading. Since then, centralized exchanges have dominated as the main gateways to market liquidity. But recent data suggests that this dominance is beginning to wane. In 2025 alone, centralized platforms accounted for $85.3 trillion in perpetual trading volume. However, decentralized exchanges are now catching up, with growing on-chain activity and product development. The CoinGecko 2026 Crypto Perpetuals report reveals that decentralized perpetual exchanges are no longer niche protocols but are becoming formidable competitors. This is evident in rising trading volume, open interest, and the pace of new product launches. Between January 2025 and April 2026, MEXC and BingX led the way in listing new perpetual contracts. MEXC added 879 contracts, averaging 55 per month, while BingX added 565, or about 35 monthly contracts. These platforms are focusing on smaller and long-tail crypto assets, suggesting a broader market expansion. 6 of the top 11 exchanges, in contrast, are more conservative, introducing fewer than 20 new perpetual contracts per month. Binance is also. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Adapting. In the last 16 months, the number of new perpetual markets it launched exceeded its spot listings, with 305 perpetual contracts and 125 spot contracts. Many of these new listings include memecoins and AI-themed tokens. This aggressive product development is reshaping the landscape. The average monthly trading volume for the top 11 centralized perpetual exchanges dropped from $7.11 trillion in 2025 to $4.69 trillion in the first 4 months of 2026, a 34% decline. BingX is an exception among centralized platforms, increasing its market share in 2026. This shift suggests a broader movement of liquidity and user activity from centralized to decentralized perpetual trading platforms. The rise of decentralized perpetual exchanges is not just about volume. It's about product innovation and the inclusion of new and emerging tokens. These platforms are enabling traders to access a broader range of assets and trading opportunities that were previously limited to centralized gateways. The report highlights that decentralized platforms are now competing on multiple fronts: volume, product variety, and user experience. As more traders seek alternatives to centralized platforms, the pressure on traditional exchanges to innovate and expand is increasing. The next signal to watch is whether this trend accelerates further in the second half of 2026. Will decentralized platforms continue to gain traction, or will centralized exchanges respond with more aggressive strategies? The answer will depend on how quickly decentralized protocols can scale and maintain liquidity, and how effectively centralized platforms can adapt to the changing market dynamics. For now, the data suggests that the shift is real and growing. The perpetual trading segment is evolving, and the balance of power is shifting. The mechanisms driving this. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Change include faster on-chain execution, improved smart contract infrastructure, and a growing user base that values transparency and control. The stakes are high. As decentralized platforms gain more traction, they could redefine the entire trading ecosystem by reducing reliance on centralized custodians and enabling peer-to-peer trading at scale. The next key signal will be how decentralized platforms manage liquidity and user adoption in the face of market volatility and regulatory scrutiny. If they can maintain their momentum, the future of perpetual trading could look very different from just a few years ago.